Hi, this is Juliet, a young Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of part 10 about investments in equity securities and debt securities. I discussed in part 10 about debt securities classified as available for sale securities. Just click above or the link below this video to watch part 10. In this video, I am going to discuss about bifurcating a compound financial instrument. Bifurcating a compound financial instrument. A compound financial instrument is one that possesses a debt characteristic and an equity characteristic. Examples are bonds with non-detachable share warrants and convertible bonds. Convertible bonds are those that could be exchanged with the issuing entity's ordinary shares at the option of the bondholders. The purchase price of a compound financial instrument whose host instrument is not classified as at fair value through profit or loss has to be split into its debt component and equity component. This process of splitting is termed bifurcation. The equity component or the share warrant or the conversion privilege of the compound financial instrument is a derivative and is therefore initially recognized at fair value. The excess of the purchase price over the fair value of the derivative is the amount assigned to the debt component. Purchase price of a component financial instrument less fair value of the equity component is equals to the value initially assigned to the debt component. To illustrate, assume that XYZ company purchased from the open market 400,000 pesos face value bonds of ABC Corporation at 110. Attached to each 1,000 pesos face value bond is a non-detachable share warrant which on this date had a market value of 10 pesos. To bifurcate the total purchase price of 440,000 pesos, the following computation is considered. Total purchase price 400,000 pesos times 110% is 440,000 pesos. Fair value of derivative asset 400,000 pesos divided by 1,000 times 10 is 4,000 pesos. The value assigned to investment in bonds is 436,000 pesos. If the bonds purchased earlier were classified as available for sale securities, XYZ should have recorded the acquisition as follows. Debit available for sale securities, XYZ bonds for 436,000 pesos. Debit derivative assets, XYZ share warrants 4,000 pesos. Credit cash 440,000 pesos. If the host contract of the compound financial instrument is designated as at fair value through profit or loss, there is no need to bifurcate, as both financial assets, in the example of the bonds and the warrants, fall under the same category. Financial assets at fair value through profit or loss. The entry for the acquisition is debit trading securities for FA through FDPL 440,000 pesos and credit cash for 440,000 pesos. Classification of equity and debt securities. The following principles shall apply to classification of investment in equity and debt securities. From and into financial assets at fair value through profit or loss. An entity shall not reclassify a financial instrument into or out of the fair value through profit or loss while it is held. Paragraph number 50, IAS or PAS number 39. That means that once securities are classified as trading securities, they would remain in that classification until they are disposed of, or until circumstances indicate that the investors exercises significant influence over the investee as a result of the investor's holdings in equity securities of the investee. In like manner, an instrument that was previously designated as available for sale equity or available for sale debt or held to maturity securities shall not be reclassified as financial asset at fair value through profit or loss. From investment in associate to available for sale securities. When an investor that accounts for investment in associate using the equity method loses its significant influence over the investee company, the investor shall discontinue the use of the equity method and shall reclassify the investment as available for sale securities. The carrying amount of the investment on the date that it ceases to be an associate shall be regarded as its cost on initial reclassification, and the investment shall be subsequently measured following the principles for available for sale securities. The entry for the reclassification is debit available for sale securities and credit investment in associate. Reclassification to investment in associate. An investment originally classified as available for sale securities may subsequently give the investor significant influence by acquiring additional shares or by some other means. If the investor does not have the intention of disposing of the shares within 12 months from the date significant influence is acquired, the securities shall be reclassified as investment in associate using the equity method. Three methods of accounting for this reclassification may be considered. Method 1. The use of the equity method requires the investor to compute the carrying value of the investment as if the equity method had been used from the date the investment was originally acquired. The adjustment to the investment balance is charged or credited to retained earnings. Any unrealized gains or losses previously taken to equity and the related market adjustment account, if used by the entity, shall be derecognized. Thus, if the investee had net cumulative profits or net of dividends declared from the date of the acquisition of investment and the market value of investment exceeds its cost, the pro forma entry for the reclassification is as follows. Debit investment in associate, remeasured based on equity method. Debit unrealized gains and losses on available for sale securities. Credit retained earnings, net adjustment to equity method. Credit available for sale securities. Credit market adjustment available for sale securities. Method number 2. This method is based on paragraph 23 of IAS number 28, which states that an investment in an associate is accounted for using the equity method from the date on which it becomes an associate. Similar to method 1, any unrealized gains and losses previously taken to equity shall be cancelled. However, there is no remeasurement of the investment balance. The cost initially assigned to the investment, net of any recognized impairment loss taken to profit or loss, shall be assigned to the investment in associate. Thus, assuming that fair value at the date of reclassification exceeds the original cost of investment, and further assuming that the entity uses a market adjustment account, the pro forma entry for the reclassification is as follows: debit investment in associate, debit unrealized gains and losses on available for sale securities, credit available for sale securities, credit make adjustment available for sale securities. Method number 3. This method is based on the reasoning that at the date significant influence is acquired, it is assumed that the previous investment is disposed of at expected disposal proceeds, which would approximate the market value. Hence, the market value at the date of reclassification is the assigned cost of the investment. Thus, any change in market value of the investment from the date of acquisition represented by the unrealized gains and losses account is taken to profit or loss. This method does not remeasure the investment balance to carrying value based on equity method and is therefore conforming to the principle that the equity method shall be adopted from the date the investment becomes an associate. The pro forma entry at the date of reclassification is as follows: debit investment in associate at market value, debit unrealized gains and losses on available for sale securities, credit available for sale securities, credit market adjustment, credit income from investment. Method number 1 is consistent with the principles of the Financial Accounting Standards Board of the United States of America. Only method 1 is illustrated in the following case. M Company at the beginning of 2008 purchased 15% of the outstanding ordinary shares of N Corporation for 1,500,000 pesos, which represents 15% of the fair value of N Corporation's net identifiable assets at that date. For the year ended December 31st, 2008, N reported profits of 500,000 pesos and paid dividends of 200,000 pesos. At December 31st, 2008, the market value of the shares of M held by N was 1,540,000 pesos. At the beginning of 2009, M purchased additional 10% of the outstanding shares of N for 1,030,000 pesos, bringing the total equity of M in N to 25% as a result of the additional acquisition. M exercises significant influence over N. At the beginning of 2009, the shares of N, which were previously classified as available for sale securities, are reclassified as investment in associate. The carrying value of the investment shall be computed based on equity method from the date of acquisition as follows: acquisition cost 1,500,000 pesos. Share in net income of N, 15% multiplied by 500,000 pesos is 75,000 pesos. Share in dividends, 15% times 200,000 pesos is 30,000 pesos. The carrying value, equity method December 31, 2006 is 1,545,000 pesos. Because the market value on December 31, 2008 was 1,540,000, there was a debit balance in the market adjustment account of 40,000 pesos, and there was a credit balance of 40,000 pesos in the net unrealized gains or losses account as part of equity. The entries at the beginning of 2009 for the reclassification and the acquisition of the additional shares are debit investment in associate, 1,545,000 pesos, debit unrealized gains and losses on available for sale securities, 40,000 pesos, credit available for sale securities, 1,500,000 pesos, credit retained earnings, 45,000 pesos, credit market adjustment available for sale securities, 40,000 pesos, reclassification of available for sale securities, debit investment in associate, 1,030,000 pesos, credit cash for 1,030,000 pesos, purchase additional 10% in N. Thank you for watching my video. I hope you learned something from this video. I did part 12 and continuation of this video wherein I discuss in part 12 about reclassification of debt securities and disclosure requirements. Just click above or the link below this video to watch part 12. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet Orfiano. See you on my next video.